Silver holders, June 20th could be a turning point. Here's why. Something is about to happen on June 20th that most silver holders don't even know to watch for. Not a news headline, not a Fed announcement, not another analyst prediction. A convergence. A collision of forces that has historically, and I mean historically, preceded some of the most violent moves silver has ever made. And right now, almost nobody is talking about it. Stay with me, because in the next 20 minutes, I'm going to walk you through exactly what's building beneath the surface of this silver market right now, and why June 20th sits at the center of it. We're going to talk about what's happening at COMEX, what's happening with the dollar, what's happening with industrial demand that the mainstream financial media keeps burying on page 12. And by the end of this video, you're going to understand something that the average retail investor, the person watching CNBC, refreshing their brokerage app, waiting for permission to act, simply does not see yet. Most people look at silver and see a volatile commodity that's hard to predict. What I'm going to show you today is a pressure system, one that has been building quietly for months, and June 20th may be the moment it finally breaks open. Let's start with the basics, because before we get to June 20th, you need to understand the structure of this market. Silver is not like stocks, it's not like crypto. It doesn't trade purely on sentiment or earnings reports. Silver trades at the intersection of two completely different worlds, and that's exactly what makes it so explosive when those worlds collide. World number one, silver as a financial asset, a store of value, a hedge against currency debasement, a monetary metal that has held purchasing power for thousands of years. World number two, silver as an industrial metal, a critical input in solar panels, electric vehicles, semiconductors, defense systems, and AI infrastructure. Here's what most investors miss. These two demand drivers don't move together. They don't cancel each other out. They stack. And right now, both of them are activating simultaneously. The financial demand for silver is rising because the macroeconomic picture, and we'll get deep into this, is pointing toward a weakening dollar, rising debt, and a Federal Reserve that is slowly, quietly, losing credibility. The industrial demand for silver is rising because the energy transition is not slowing down. Solar deployment globally is accelerating at a pace that the silver market was never structured to absorb. Two worlds, both pulling silver in the same direction, at the same time. That doesn't happen often, and when it does, history has something very specific to say. So why June 20th? Let me give you the pieces. June 20th, 2026 falls at a critical intersection of market structure events. It marks the approach of a quarterly COMEX options expiration window, a moment when the paper silver market becomes unusually vulnerable to positioning shifts. Here's something most retail investors have never been taught about how silver is actually priced. The price you see on your screen right now, that's not a pure reflection of supply and demand. It's a reflection of contracts, paper contracts, futures positions held by large financial institutions, banks, and funds that have almost nothing to do with the physical metal sitting in a vault somewhere. COMEX, the commodity exchange where silver futures trade, handles a volume of silver contracts that dwarfs the amount of physical silver that actually exists and is available for delivery. Think about that for a moment. The price of a physical, finite, industrially critical metal is being set every single day by a paper market that is structurally disconnected from physical reality. That is not a conspiracy theory. That is literally how the system was designed. Now, around options expiration dates, and June 20th sits within one of those windows, something historically predictable begins to happen. Large players who are short silver, meaning they've bet on the price going down or staying flat, have to manage their exposure. They either cover, roll, or defend. And when the physical market is tight, when real buyers are pulling real metal off the market, the cost of that defense goes up, sometimes dramatically. Let me paint you a picture of what a physical squeeze actually looks like. It starts quietly. It always does. Industrial buyers, solar manufacturers in China, EV battery producers in Europe, defense contractors in the United States, they start placing larger forward orders. Not because silver is exciting, not because they watched a YouTube video, because their procurement teams ran the numbers and realized that waiting costs more than buying now. Meanwhile, ETF flows begin to shift. Investors who have been sitting in cash, waiting for clarity on interest rates, start rotating into hard assets. Silver ETFs start absorbing metal. Physical dealers report tightening inventory. Premiums start creeping up. At COMEX, the registered inventory, the the metal that's actually available for delivery, starts declining. Not catastrophically, just steadily, quietly. And then, around an option's expiration date, the paper positioning has to reconcile with that physical reality. The shorts, the large institutions that have kept a lid on silver's price for months, face a choice. Do they cover at a loss? Do they roll their positions forward and hope the physical tightness resolves? Or do they try to suppress price one more time, now against a tighter and more determined physical market? History shows us what happens when they try to suppress against a truly tight physical market. Silver went from under $6 to nearly $50 in less than a year. Silver ran from under $20 to nearly $50 in 8 months. I'm not telling you we're headed to $50 next week. What I am telling you is that the structural conditions that preceded both of those moves share disturbing similarities with what we are seeing right now in 2026. The macro layer. Now let's zoom out. Because the June 20th COMEX story is only one part of this. The bigger picture is what's happening to the dollar. The United States is carrying a national debt that now exceeds $36 trillion. The interest payments on that debt, just the interest, are running at roughly $1 trillion per year, more than the entire defense budget. Think about what that means for a moment. The Federal Reserve has spent the last several years trying to fight inflation with higher interest rates. But here's the trap they've built for themselves. Higher interest rates mean higher debt servicing costs. Higher debt servicing costs mean the government has to borrow even more just to pay the interest on what it already owes, which means more dollars get created, which means the purchasing power of each existing dollar continues to erode. It's a cycle, and there is no clean exit. When the dollar weakens, and structurally it is biased to weaken, hard assets reprice upward. Gold moves first, because gold is the most financially oriented of the metals. Then silver follows. And historically, silver doesn't just follow gold. It catches up and then overshoots. The gold-silver ratio right now is sitting at levels that, in every previous cycle, have preceded silver dramatically outperforming gold. When the ratio compresses, when silver closes the gap against gold, the moves in silver are not incremental. They are violent and fast. And here's the geopolitical layer that almost nobody in mainstream finance wants to discuss seriously. De-dollarization is real. It is not a fringe theory. Central banks around the world, not just Russia, not just China, but India, Brazil, the Gulf states, are actively reducing their exposure to US dollar reserves. They are buying gold at record levels. They are building alternative payment systems. What does that mean for silver? It means that one of the traditional mechanisms for suppressing commodity prices, a structurally strong dollar, is slowly being dismantled. Not overnight, not in one dramatic moment, but piece by piece, year by year, the architecture that kept dollar-denominated commodities artificially compressed is being eroded. When that architecture finally gives way, and historical precedent suggests it doesn't give way slowly, the repricing of silver will not give retail investors time to prepare. The solar demand wildcard. There is one more factor that I think is genuinely underappreciated, even among people who follow silver closely: solar. The global solar industry consumed more silver in 2024 than the entire global silver mining supply could produce in isolation. And solar deployment is accelerating, not slowing. The International Energy Agency projects that solar capacity additions over the next 5 years will require silver supply that the mining industry, even running at full capacity, simply cannot provide fast enough. This is not a demand story that goes away if interest rates stay high. This is not a demand story that reverses if the Fed pivots or doesn't pivot. This is structural, non-discretionary industrial demand that has no substitute. You cannot make a high-efficiency solar panel without silver. The conductivity requirements are not met by copper. They are not met by aluminum. Silver is the only metal that does what silver does at the scale that modern solar cells require. And the mining industry is not coming to the rescue. Average silver ore grades globally have been declining for decades. The easy deposits were found and mined. What's left requires more energy, more capital, more time, and produces less metal per ton of rock moved. Supply is structurally constrained, demand is structurally rising, and the financial market for silver is priced as if none of this is true. That is the mispricing. That is the opportunity. Here's something worth understanding about how markets actually work. By the time a story is on the front page of the Wall Street Journal, by the time your neighbor mentions it, by the time it's trending on social media, the opportunity has already been priced in. The people who made real money on that story got in early, quietly, before the crowd. Smart money does not wait for confirmation. Smart money reads the structural signals. The COMEX data, the ETF flow data, the industrial procurement patterns, the currency dynamics, the geopolitical shifts, and it positions before the narrative becomes obvious. The narrative for silver is not yet obvious to the mainstream. Most investors still see it as a speculative metal, a gamble, something you buy when you're feeling paranoid about the economy. They don't see the industrial supercycle. They don't see the monetary repricing. They don't see the COMEX structural tension that builds around dates like June 20th. But some people do. And the question you have to ask yourself, watching this video, sitting with this information, is which side of that awareness do you want to be on? Not the side that reads about the silver move after it happens. Not the side that says, I knew that was coming. The side that was positioned before the moment arrived. Conditional predictions. Now let me be precise about what I'm saying and what I'm not saying. I am not telling you silver is going to explode on June 20th. Markets are complex. Timing is never guaranteed. Anyone who gives you a precise date and a precise price target for any commodity is either lying to you or lying to themselves. What I am telling you is this. If the COMEX physical inventory continues to tighten heading into this expiration window, and current data suggests it is, then the cost of maintaining short positions increases significantly. If the dollar continues its structural weakening trajectory and the debt dynamics make a sustained dollar recovery mathematically difficult, then the tailwind behind hard assets remains in place. If industrial silver demand continues to outpace new mine supply, and the structural projections from every credible commodities research house suggest it will, then the fundamental case for silver repricing only gets stronger over time. And if the gold-silver ratio continues to sit at historically elevated levels, which it does as of this recording, then the historical pattern says silver has significant room to outperform gold in the coming months. None of these are promises. All of them are historically grounded, structurally supported observations. The math points in one direction. So here's where we land. June 20th is not a magic date. It's a focal point. A moment where multiple pressure systems converge. COMEX positioning, macroeconomic momentum, dollar dynamics, industrial demand. In a way that historically has preceded significant price action. Whether that action comes precisely on June 20th, or in the weeks surrounding it, or whether this particular window passes quietly and the pressure continues to build toward the next catalyst, that nobody can tell you with certainty. But here's what I know with certainty. The structural case for silver has never been more compelling. The supply deficit is real. The industrial demand is real. The monetary debasement is real. The geopolitical de-dollarization is real. The COMEX paper market's increasing tension against a tightening physical market is real. These are not opinions. These are measurable, documented, observable facts. The question is not whether silver eventually reprices to reflect these realities. The question is whether you're positioned before it does. Most people won't be. Most people will watch it happen. They'll see the headlines. They'll see the charts. And they'll say, I knew that was coming. I just didn't move in time. Don't be that person. The window to be early is open. It will not stay open forever. Watch June 20th. Watch the COMEX data. Watch the dollar. Watch the gold-silver ratio. And ask yourself, if everything I've laid out in this video continues on its current trajectory, what does the silver market look like 12 months from now? The answer to that question is why people who understand this market aren't waiting. I'll see you in the next one.